Hello, good evening, everyone. My name is Vikas Agrawal. Firstly, sorry for the inconvenience. Today we had some technical issues, but anyways, that same has been sorted out. So it's a very special day because we've invited Mr. Prateek Agrawal. He's the business head and chief investment officer at ASK Investment Managers. He brings about more than 2.5 decades of experience in terms of equity investing in India. He works very closely with Bharat Bhai as well, and he's been instrumental right from the day one in terms of defining the investment philosophy of the organization, and taking care of multiple funds as an head of equities. And today we thought we'll try and read his mind and understand what was the logic behind launching the fund called ASK, AIF, which is called Golden Decade. And then we'll also deep dive the strategies, and also try and understand what sort of risk which is involved at this point of time in the markets. And we'll take his opinion about the outlook of equity markets as well. So overall, we've got about 30 minutes to go. So we'll start the discussion. So my first question to you, Pratik ji, firstly, would like to thank you for taking the time out from your busy schedule and joining in today. My first question to you is, what was the logic behind launching this Golden Decade Fund at this point of time? What is your view about the economy 10 years down the line?
No, no, thank you. Thank you for having me. The name says it all. It is called a Golden Ticket Fund. We believe over the next 10 years, India will see a growth, which would be better than what we have seen in the past, let's say 15 years. Last 15 years, the country went through a lot of turmoil. There was government changes, there was bank loan issues which had to be sorted out, ILFS, etc., which probably which probably brought down the overall growth rates. Now that the structural reforms, the tough job has been done, what we are seeing is very positive government policy moves, and you are sensing it happen. Anything that is hitting the industry is getting sorted off pretty quickly. PLI benefits have been extended, they have been welcomed by the industry. You see import duty protection coming in very, very quickly as well, giving a lot of confidence to the industry to actually start on another round of capex. So golden decade because yes, consumption continues. Golden decade also because after 2003 we are looking at all three capex parts. Be it being done by the government. You saw a large increase in the budget. Be it people like you and me buying houses. So house buying activity has been stronger than before. Be it corporates, corporate capex was simply not happening, and 2016, 17, 18 were very tough years. But now even their sentiment has changed, and we are seeing more commitments now than before. The fact that commodity prices are higher, and you have seen, metal mining companies repay debt, repair balance sheets, so they are now again embarking on newer capex. Apart from even textiles, two traditional areas which absorb a lot of capex, and of course newer areas like electric vehicles, etc. So normal corporate capex has started. PLI induced capex is further providing a fillip. So we believe growth in India should continue for a length of time. It is not a one period thing that we are seeing. Yes, current higher prices do impact growth outlook. Before the oil prices became so high, if we were expecting close to 9% kind of GDP growth for financial 22, 23, now we are expecting 7.5% kind of GDP growth. So that kind of impairment has happened. But that said, if you look at the medium to long term, 5 to 10 years kind of journey, growth rates in the country would be high. Now, if growth rates are high, our style, which focuses on high quality, high growth combination, should be in work, should do very well, and hence, that gave us a lot of confidence to bring about this portfolio. At the same time, maybe I'll dwell upon it a bit later. The big thought, is how do we get growth for longer? If we have to make more returns than the market for our investors, we have to seek out growth which is a tad more than average, and maybe lasting for longer than average. And one big thing that can provide tailwinds to an otherwise also good management, good business, is the thought of value transfer. We see a lot of that happening around us, giving lot of businesses a very very strong tailwind, and that is the space that this golden ticket fund would focus at. In fact, we had launched this with Motilal on an exclusive basis 3.5 years back. Did very well, and then on popular demand, this is the second avatar of the same. So the proof of concept is there. It's seen strong performance over 3.5 years, and now we have again brought it out for everybody to participate.
Do you think that this decade is called golden decade only for India, or overall as an emerging economies, all the Asian countries are likely to do well?
So I think we as an economy are very nicely positioned. Other economies are more narrow than India. So, for example, Thailand, Sri Lanka are more dependent on, let's say, tourist traffic. We are less. We are very diversified as an economy, and our chances of doing better are higher. So, if you look at actually emerging markets, and if you look at BRICS, there are very few who have stood the test of time. Most have fallen over the journey. Be it Brazil, be it Russia, China also having their own issues. So, अगर आप BRIC देखो तो of the original BRIC, we are the only guys standing. We are starting off a lower base. Our per capita is at just $2,000 per year. Other countries have more, and in some sense, it is probably easier for us to also grow from de facto extreme poverty that we see in this country to lesser poverty, and then maybe to some amount of middle income level. So that itself will give our country a strong growth momentum. So I think we should believe in many ways that the next decade could be India's decade. This is a country which has been growing well, has a great prospect of doing well over the next 10 years, and supported by the fact that we have the people to give businesses scale. Other emerging markets do not have large populations. In a period like now, when the wheels of globalization are stopped, if not turned back, earlier scenario that you saw, you could manufacture in Malaysia to export into India, manufacture in China to export into India, is increasingly more difficult. So you should see the response to Tesla. They wanted certain discounts while initially they would have manufactured in China. They were graciously told not done. We are letting it be known that if you want to access Indian markets, jolly well manufacture in this country. And I think that's a pretty powerful message that is going across, giving our businesses much more scalability than before. So this is good. I think while many countries will do well Indonesia also has a lot of population. They are also endowed richly with natural wealth. But I do believe that over the next decade, India has a great chance of standing out. It could be the decade of India if our policy making supports. As yet, we see positive policy making, a very, very positive policy making, and that reinforces our belief in our country.
Thank you for throwing more lights on that. So, Prateek ji, which are the sectors you think are going to be the biggest beneficiary of the value migration that you talked about?
Yeah. No, sure. Coming down to the value migration theme, we see it around us. Happening in many spaces. So to give you the example that all of you will latch on to very quickly, look at the financial space. Earlier, a lot of us would go to public sector to get the work done. Now, most of us would have accounts in private sector banks. People in business would be getting more loans from private sector versus public sector, and that is a space where a lot of value transfer is happening. Last bastion of public sector, apart from metal mining, it's happening in insurance. So while the LIC issue is on, LIC's market share is now just about equal that of all other private sector companies put together. While in terms of stock, they still have a large stock, but in terms of incremental business, it's now 50% private. Airlines, we just saw the last public sector one got sold to private sector. So this is a value transfer that has taken place over time. We'll continue to do the same going forward. There are more examples. So in each one of these, in airlines, for example, look at an Indigo. If you look at banks, you get several names. Axis Bank, IndusInd, ICICI, HDFC, AU Bank, making money over very long periods of time. Yes, some of them may be floundering in the near past, but the point is over 2002 to 2022 kind of a period. The private sector banks have made humongous amount of wealth for investors, while government banks may have struggled over this journey. Now, the other space that I can talk about where this is being seen very strongly is unorganized to organized formalization of the economy. So, for example, in grocery shopping, increasingly people are going more shopping from, let's say, places like DMart, and you see it creating a lot of value versus the mom and pop neighboring grocery stores. Similarly, in jewelry, going to a Titan kind of a franchise versus family jeweler. Seen in diagnostic chains where doctor run shows are now giving way to organized sector players like Dr. Lal and Metropolitan, Vijaya from South, and so on. So, very clearly, this is seen. It's happening in, let's say, footwear, clothing, being other spaces. So, a page making a lot of money over very long period of time. Relaxo kind of a name doing so in footwear. So when I take these names, it would have occurred to you that most of them are leaders in their spaces. Most of them are quality leaders also, high or the highest ROCs in this space, and yet all of them have shown ability to grow very strongly for several years. That is the combination we seek. In many ways, we call them best of India. It's not by size. It is the ability to make more money. It is the ability to grow while making more money, and not for 1 year but multiple years. That I think is a very difficult do. These businesses have done it, and this is what is our focus across whatever we do. If you get tailwinds of, let's say, value transfer that we are talking of, that just like I said before increases the growth and makes it more durable, thereby probably allowing our fund manager to make a bit more money than otherwise. I can give you more
Sure, thank you.
examples what is happening, let's say, in automobile, internal combustion engines to electric vehicles.
Yeah, yeah. Okay, okay. So, Prateek ji, there are few investors who are curious to know about this. So, would there be some different positions in the AIF than PMS, particularly in golden decade A? And B is, if yes, then what is the reason behind? Because it has a tenure of 4 years.
No, so AIF versus PMS, the AIF vehicle has certain advantages. In PMS, also our PMSs have exit loads. This AIF has exit loads like PMSs. Yes, duration is 4 years. In PMS, we seek long period investments and keep the exit load for 3 years. So there is a slight difference, but that's about it. Uh, AIF as a vehicle is slightly better than PMS. One, it gives the investors tax post-tax returns. In PMS, you will have to put in your own taxes, like you do when you buy and sell shares on your own. Second, in an AIF platform, we come in as an institutional investor and can participate in IPOs. That in some cases can help generate alpha as well. So I think those are the two things. Otherwise, as a house, we are present both on PMS and AIF, and we believe both platforms are equally good for running this kind of a strategy.
Yeah, the other thing is in your strategy, we saw that it can extend by 2 more years. So you foresee that it is going to happen, or it's only a kind of a stepney tire, which like if anything goes bad, then that is the time you want to use that.
No, see if anything goes bad, or if we extend it, the investors can still get out. That's not an issue at all. Without exit loads, it is up to them. Thing is, if there is a case, I mean, you said something bad happens, something good can also happen, and investors may just want to continue. So the way it works is we will ask the investors through our email whether they would wish to continue. If 75% of the investors are okay, so if they do not respond, it means they are okay. Okay, then we can extend. But any investor who wishes to go after 4 years can go without exit loads. 4 years from the date of final closure. There is no exit load after 4 years. It is completely voluntary. So investors should not be worried. If they want the money, they can take it. Distributors should not be worried either. It is to enable. I mean, we really thought performance would be good, and investors would want to continue, and hence we have put that enabler there. In fact, the first AIF that we launched was called 2025. It's a 7-year AIF, and no exit possibilities for first 5 years, and then exit load kind of stuff. So here we have actually diluted the or enabled exit for unforeseen situations kind of stuff for investors.
All right. So with that, we'll open the forum for question and answer. I'm done with all my questions. So I would request dear participants to please type in their questions in Q&A box, or if you wish to type, you can type in the chat box as well. So the first question, which is already there, is for Prateek ji. Uh, do you think this will outperform your PMS? That's the first question. I think it's already an existing investor.
No, no. So all of our products are equally dear to us. We believe each one of our products have a good chance to do well. Uh, and this one has as good a chance to do well. In fact, if you look at some of our other products, we are guys who believe if you focus, you will do better. And IP portfolio, for example, which is our largest, we focus on entrepreneurs to deliver growth and with growth make us money. So that's a slightly different orientation versus this one where we are saying it is value transfer that will give us that added amount of growth. So I think here the fund manager may have greater flexibility. He can look at insurance businesses, he can look at professionally run businesses like ICICI, HDFC Bank kind of names. So he has a richer choice than some of our other PMSs. If he uses that choice better, then I think there's a great chance that this product performs well. We have definitely provided the enablers. Over last 3.5 years, this has been the best performing product for us across our other AIFs and PMSs. So, and it was with this strength that we brought it out again in an AIF format.
Okay, the second question is what kind of earnings you are looking at an aggregated level of the portfolio that you want to build in AI?
Yeah. So over the next 2 years, the earnings growth in the market itself is expected to be very fast from 715 to 720 EPS in financial 22. We should go to around 860 in financial 23 and close to 1000 in financial 24. So I think the our portfolios always aim for 4 to 5% higher CAGR in earnings versus the market over this period of 2 years. I think we will be just 2-3% higher than market, but then as we go forward, let's say 25 over 24, and expect earnings growth in market to fall to 10-12%, and at that point in time, our companies could be delivering much more. In the near term, since we are coming out of a dip in earnings because of COVID, because of whatever, the broad market earnings growth and for our portfolios, the gap could be smaller, but as it normalizes on the index, the gaps could increase. We aim for 4 to 5% higher earnings growth. If you look at the filtration slide on the GDL portfolio, we aim for over 20% CAGR growth in earnings. Now, the index CAGR growth over 1993 to 2022 has been of the order of 12% in earnings. And if we get anywhere close to 20, even if it is 18, it is still that 6% delta that we would get. The whole thought is higher growth would result in higher returns for our investors, even adjusting for fees.
Maybe I'll take the last question. So next is if the liquidity is not there and if not this AIF, then which PMS to be looked at, IEP or EOP, emerging opportunity?
No, that is best answered by yourselves. IIP is our largest portfolio, 20,000 crores, flexi cap, very long period track record. In some manners, God's gift to our house. So you wish to be there, very good. EOP is differently positioned. It is with sector leaders, okay, in emerging spaces. So 80% of the portfolio is a mid cap portfolio. When I say mid cap, most of them are larger mid caps. We hope that with time and with more rapid growth, some of them would become larger caps. The overlap between IP and EOP is very low. And in fact, if you are considering, it would be a great idea to do both. To get a much better flavor of our house.
I would also like to add here that it's more to do with your risk appetite, so I would suggest that you book a call with our expert team and We will help you measure your risk level, risk appetite, and basis that we can choose, which strategy to be looked at. So yeah, so I think with that, we'd like to conclude the session here and take this opportunity to thank Prateek ji for taking the time out from his busy schedule and joining in. And I also take this opportunity to thank all the participants for
Thank you.
joining
Thank
in
you
today. Thank
everyone.
you.